Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Laurentian Bank is the best performing stock in Toronto today. Shares surging after the lender announced it's selling some of its assets to Fairstone Bank for $1.9 billion, or $40.50 a share in cash. Separately, National Bank will acquire all of Laurentian's retail and small business assets. Laurentian will focus on commercial real estate lending. And Eric Provost, the president and CEO of Laurentian Bank, will join us on the show at 3:40 p.m. Eastern Time. Shares of Shopify seeing a spike after its merchants racked up $14 billion U.S. in Black Friday sales. That's a new record for the company. Shopify says merchants saw strong demand in apparel, home goods, and beauty products, with peak sales hitting more than $4 million a minute. Canada, the U.S., Germany, and Australia among the highest-selling countries. Shares of GoEasy seeing some pressure today. The CEO, Dan Rees, will step down from the consumer lender by end of year. A blood disorder requires him to resign. Patrick Enns, current president of Easy Financial, will become the CEO January 1st. And Rees will serve as special advisor to the CEO through June 30th. Home sales across Vancouver fell last month. Vancouver's real estate board says the number of keys changing hands fell more than 15% in November compared to the year before. The benchmark price of a home also dropped. A quick look at where we stand on the North American markets right now. The TSX closed the gap, started out with a bigger divide at the start of the day, but now just 62 points down to 31,039. Moving south of the border, the S&P 500 has a 29-point gain today, 0.4%. The Dow Jones gaining 289 points, 0.6%, and the Nasdaq up 181 points, 0.8%. Scotiabank, the first big Canadian bank to report earnings this week. The company beat in profits after announcing layoffs in October. Denny Taillefer's portfolio manager at Caldwell Investment and joins us now to talk about the latest quarter. Thanks for joining us today.
Right.
A strong quarter for wealth management for Scotiabank. Has this been a focus for the bank?
You know, it has been a focus for the bank. So they're really trying to, grow that business, grow that fee business. So it's a capital light type business, which will really help drive better ROEs on a go forward basis. So they did very well in that segment. Having said that, I think the market's expecting all the banks to do very well in their capital markets division because we've seen very high levels of trading. We've seen a lot more deals happening. And as well, the assets under management, we've had really good markets over the last few years. So the assets under management have grown just along with the market. So your fee based on that asset base keeps growing as well. So it was expected, and it is expected for all the banks. It's a little hard to kind of split up how much of it has to do with the initiatives the company has taken and just the overall market. But over time, I think we'll be able to compare how they're doing versus their peers and how they're doing over time and how that part of their business keeps growing, because that will be a big driver of them improving their ROE over time.
Going into the end of the year, how has Scotiabank performed compared to the other big banks?
So, if you look at Scotiabank's performance over the longer term, like 5 years, they've really underperformed the other banks quite significantly. But over the last 2 years, so they had their investor day on December 13th of 2023. And from that point on, they've pretty much well been in line with the overall banking index in Canada. So they've basically kept pace with the rest of the banks as they're basically kind of executing on their plan to kind of reposition their businesses, both in the South America or the Latin American part of their business, as well as their North American and Canadian businesses. So they've been executing fairly well, and they've been able to keep pace with the banks. Having said that, they still trade at a discount to the overall banks. But we think if they can continue performing that way, they will be able to close some of that gap.
What does their mortgage portfolio look like at this time?
So the mortgage portfolio, interestingly enough, they spoke to it on the call. They did see some weakness in certain pockets of the market. So the Greater Toronto market, as well the Greater Vancouver area market, have been under pressure. So they've seen a slightly higher delinquencies in the mortgage book there. Having said that, nothing too alarming. And it's been also a little more focused on the condo markets in each market. Overall, their loan book is very, I'd say very strong, very high quality. So about 94% of the loan book is secured. They've got very low loan to asset values on that loan book, and their FICO scores are very high. So there's no real big concern there, but they did point out that they've seen some weakness in a few of the pockets of the market that they deal in.
Denny, they laid off more than, I think, 2,000 people, close to 2,500 recently. What kind of charge are they taking connected to those layoffs?
So yeah, they're taking I can't remember the number now, but I think it's a fairly significant charge. We expect to see that over time with the banks. There's going to be a lot of investments in technology, and we will see, obviously, that will drive productivity and so forth, and that will have two impacts. One, I think they'll really slow down the hiring in a lot of their departments, but as well, we'll probably see a lot of people retiring and not hiring back so quickly, and then a mix of layoffs here and there. So over time, we expect to see more of that, and that will just help really drive the cost portion of running the business lower. And we think that will be a big driver to earnings growth for most of the banks on a go-forward basis here.
Okay, so where does this bank have potential for growth? You mentioned, or we started talking about the fact that wealth management is big for them. That has grown significantly. Clearly, the year they've had has benefited them for capital markets. But where could they grow?
So the international business as well, they've kind of repositioned the portfolio there. So the Latin American business is now much more focused on Mexico, Peru, and Chile. So basically, they've got a strategy there where they're going to really focus on the higher value type clients, where they can really cross-sell and drive a lot more value with their client base. The U.S. is probably another big leg opportunity for Scotiabank. They're probably underrepresented there. They do want to be the Bank of the Americas, so they're going to have to straighten that or create or grow more scale in that market. They spoke to, they were asked about M&A on the call. It doesn't seem to be a focus today, but I have to think down the road, M&A will become a bigger part of the story, and the U.S. market will probably become a bigger part of the growth story for Bank of Nova Scotia. All
right, Denis Taifer, we'll leave it there. Thank you for joining us today. Appreciate it.
Thanks for having me.
Coming up, another small Canadian bank off the market. Laurentian is selling itself in two chunks to Fairstone Bank and National Bank. Details when we come back. Laurentian Bank up more than 18% after it announced a split sale to Fairstone and National Banks. For more on that, let's go to BNN Bloomberg. Lindsay Biscaya, she joins us now. So a big spike for shares today for Laurentian Bank.
Yeah, it was a big spike. So a lot of analysts are saying that this is a really good day for Laurentian shareholders. Like, this bank has been dealt its fair share of struggles over the last few years. And a lot of analysts are saying, it just doesn't have the capital to keep up with some of the other big banks within Canada. So an interesting development talking about this split sale. Fairstone Bank acquiring Laurentian Bank for $1.9 billion in cash. And then as part of that deal, National Bank of Canada is buying the deposits and loans of Laurentian. So Fairstone Bank will pay $40.50 per Laurentian share in cash. That's how this is going to work. National Bank will pay based on outstanding balances at the close. And for Laurentian branches and employees, it's important to note they are not going to be transferred over to National Bank. So it sounds as though there will potentially be layoffs when some of these branches close in Quebec. But we have heard as well that those employees from Laurentian Bank who are laid off will get kind of like first dibs at job openings within National Bank. So we'll have to see how that pans out. The CEO will remain, and the head office will stay in Montreal. So this deal is still subject for approval. Shareholders of Laurentian need to vote on it. 2/3 need to vote, majority for this to pass. But many analysts saying, this is a 20% premium to yesterday's close. So it would be hard to imagine that this vote wouldn't go ahead.
Yeah, and it looks like where they are today with the share price is representative with that 20% premium now there. So a good one for investors, I guess is what you're hearing?
Yeah, exactly. So they were up, last I checked, was more than 18% today, Laurentian Bank. So it sounds like a good news situation for Laurentian Bank. This is a one-year chart that we're looking at right now. The other thing that I know there's a lot of interest in, and I know we're going to keep talking about Laurentian Bank in just a moment, but National Bank, of course, with the partial sale, this kind of third-party sale, National Bank doing incredibly well today. Their stock hitting an all-time high. Last I checked, it was over $169 a share. And a lot of people saying that that's kind of what to watch for in the future as well in National Bank, and that kind of reaction to this, because they've just been doing so well this year and acquiring the good parts of Laurentian Bank, but not so much the baggage in terms of what Laurentian Bank has been dealing with over the last couple of years is probably going to be very beneficial to National Bank. All
right. And as you saw, the stock moving up again, almost at 171. Thanks for that information. All right. Well, the president and CEO of Laurentian Bank, Eric Breveau, joined us now to talk some more about this agreement. Thanks for joining us today.
Good afternoon.
Did it make the most sense to split up your business?
Well, as we highlighted in our strategic plan in May 2024, we were looking for partnerships and ways to actually be able to move away from the big banks model and focus on our strength, which we strongly believe is commercial banking, and we've been quite good at this over the years. So it landed this way because we developed quite a good rapport with Fairstone Bank, and the outcome for our retail customers lending to National Bank is actually great, because another very solid Quebec-based bank, and that will offer actually our customers a broader scope of product, and more importantly, much better technology in terms of banking tools.
So the Laurentian brand itself will be kept, is that correct?
Yes, and that's another great news for us today, is that we will operate under the umbrella of Fairstone Bank as a subsidiary. I get the privilege to continue and lead that great team based here out of Montreal, and we'll continue. This opportunity for us is amazing, because we'll be able to continue and grow in segments where we exceed, and I believe this will create even more opportunity for us in the future.
That being said, your branches in Quebec under the Laurentian Bank name will close. How many employees will lose their jobs?
Yeah, that's the sad part, and there's always a component in those strategic decisions that makes it so difficult. But at the end of this process, and again, not as of in the upcoming period, this needs to get approval by our shareholders and the regulatory, but at the end of the transition process towards National Bank, we'll be closing our branches here in Quebec, and about 700 people will be impacted by this decision of restructuring our retail activities.
Yeah, so quite a few. Okay, there were challenges of being a smaller bank operating in Canada. Can you explain one or two of the bigger challenges you faced?
Well, actually, I think it's related also to our positioning, being a very focused regional bank here, as well as the lag and gaps we add in terms of technology, and really the fact that we weren't able to attract new customers, and the investment required to equip ourselves with the right tools on a digital front, and that did not justify the investment and the return. So like I said from the get-go, at our strategic plan, we really wanted to focus more on our strength, and this transactions allow us to actually accelerate this plan.
You were looking for buyers about 2 years ago. Were either of these companies, either Fairstone or National, interested at the time?
I won't really come back on the process. We all know it didn't land anywhere, and we got to where we are today. I'm very, very happy with this conclusion, because, as I said, and I'm reinforcing, if we were to be acquired by a large bank, I believe it would have been the end of a great institution, 180 years close to existence here in Quebec. And I think Fairstone recognized the brand, recognized the value there. And for us, it's a new chapter. We're turning a page today, but definitely opens up for a great future for this organization.
You need the 2/3 support of shareholders. What have you learned from shareholders so far about this deal? Whose support do you already have?
Yeah, well, our biggest shareholder, Caisse de dépôt, CDPQ here in Quebec, that has been a long-time shareholder and big support of us, has agreed for voting support in favor of this transaction, which is major for us and send the right signal that this is a good transaction for our shareholders.
Have you heard from other shareholders?
Well, no, not directly, but the most important one is definitely CDPQ for us.
So what does this mean for bank clients, individuals and commercial clients? If you could just explain the way forward for them.
Yeah, so for our clients, the message is you have nothing to do. Like, we are going to take care of the transition, the migration, working with National Bank to make sure that it's an easy and simple process. So no actions. And by the way, all our operations are continuing as they were before. Like, our people are in the branches. We now have a page on our website that is dedicated to Q&A, as well as a dedicated phone number for customers to reach if they have questions. And please, I'd like to remember all of our customers listening, we will not reach out by text or by email and asking you to click on anything. Like, this is not the way we're going to communicate with you. And please beware, like, be careful, because some out there will try to benefit from an announcement like this. And this is not the way we operate. So please, wait for us to reach out in a way that is either paper or through our application or website, and nothing to do right now. Like, we'll keep you posted and informed while we progress towards a transition.
All right, Eric Prevost, I do have to leave it there. So thank you for joining us on this agreement. Appreciate your time.
Thank you for having me.
U.S. tariffs have taken a toll on Canada's steel industry, specifically Algoma Steel in Ontario. It's laying off half of its workforce, or about that. We have some more details on that story in just a moment. U.S. tariffs have taken a toll on Canada's steel industry, specifically Ontario's Algoma Steel. It's laying off almost half of its workforce. CTV's Abigail Beeman has more on that.
1,000 layoff notices at Algoma Steel, more than a third of its 2,700 workers in Sault Ste. Marie.
It's very devastating when you live in a community that doesn't have a lot of job opportunities and you're finding out that your job is going to end.
In a statement, the company blamed American tariffs. As a result of these pressures, Algoma has been forced to conclude its long history as an integrated steel manufacturer and close its blast furnace and coke-making operations in early 2026. Algoma will transition to electric arc furnace steelmaking at that time, a year earlier than previously anticipated or planned.
Moving away from the older blast furnaces to new electric furnaces, really as an environmental thing, that's a good thing to happen. Now they're having to do that with a gun in their head because of the tariffs.
In September, the federal government gave Algoma a $400 million loan, the province $100 million.
Our thoughts are with them. The Prime Minister looked them in the eye and promised he would protect their jobs.
My team and I have been in contact with Algoma's leadership team. We absolutely have every confidence in the Algoma workers as they're going through this hardship, and we will make sure that we support them.
The union says the government offered money without proper conditions to protect workers.
This city cannot provide employment for 900 additional job seekers.
To help those workers, the city's mayor wants to push other local projects like a deep-sea port.
We're going to make sure that those files are in front of the Premier's office, in front of the Prime Minister's office.
Ontario says it's launching a local centre to help impacted workers, including retraining. The layoffs take effect in March of next year.
CTV's Abigail Beeman reporting. After a weekend of hunting for the best Black Friday deals, how much are Canadians willing to spend the holiday season? CTV's Adrian Gabriel takes a look at that.
December has arrived, and with it, a flurry of Canadian consumers.
Buying on sale matters a lot. The sales haven't been that good either.
We'll favor Canadian, even if it means a little higher price.
A survey by the Bank of Montreal has found that 3 in 5 Canadians are adjusting their holiday spending amid tariff concerns, with 37% focusing on made-in-Canada gifts.
Being a bit patriotic about, how they want to spend their money over the holiday season to sort of give back into the Canadian economy.
The economic headwinds from inflation to debt levels are causing some to keep a tighter grip on their wallets.
What consumers are saying, the top of the list is to save money this holiday season. And so if you're going to be marketing online for Cyber Monday, I suspect you're going to be bringing out your best deals.
And cost-conscious Canadians are shifting purchase priorities. This survey by the Business Development Bank of Canada says the average household is spending just over $940 this year. More than half of that is expected to go towards Canadian products, contributing to $11 billion to Canada's GDP while supporting thousands of jobs.
Canadians are really being mindful of how they're going to spend their money over the holidays and where they want to put their money. And I think for a large chunk, it still is going to be around supporting, Canadian businesses.
All Canadian.
All Canadian, all the time, everything.
Financial experts say taking the time to map out your shopping list as well as planning your purchases in advance are key to keeping a cap on your budget, trying to avoid those impulse buys and any last-minute shopping. The calendar has turned to December, and for those celebrating, the clock is ticking to get your gifts. Adrian Gabriel, CTV News, Toronto.
Let's have a last look at the markets before the end of the trading day. The TSX down 69 points, closing earlier wider gap in the day. 31,031 is where we stand right now. Let's move south of the border and have a quick look. The S&P 500 17-point move today, not a great deal. The Dow Jones a 204-point move on the day, up 0.43%. And the Nasdaq 138-point move up. The closing bells are up next on Bay Street and Wall Street. Stay tuned. Here are the closing bells for the end of the trading day. At the Nasdaq today, SEC Chairman Paul S. Atkins ringing the bell. In New York, it's United Way ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ended the day down 52 points today, but the rest of the major North American markets are in the green. S&P 500 gaining 16 points or 0.25, a quarter of 1%. The Nasdaq had a 137-point move up, about 0.6 of 1%. The day is sort of mixed, with Bitcoin making some gains back and tech names also recovering a little bit after losing ground yesterday. Let's get to the big movers in Toronto. Laurentian Bank, of course, shares spiking, moving 18.4% up, gain of $6.21, just shy of $40 a share today. It, of course, announced a deal that splits its business in two. We'll have more on that story in just a moment. Shopify gaining today as well, almost 5%, 4.9 is where it ended the day up, $10.25 move to $219.36, and it is up 35% on the year. Some strong Black Friday and weekend sales reported by Shopify. Energy Fuels gaining as well, close to 7% or $1.37 to $21.03. And then Go Easy announcing today a leadership change that dragged shares down almost 6%, 5.9%, a loss of $8.10 to $129.08. Let's get to some of the movers with Bloomberg's equities reporter Stephanie Hughes. She joins us now. Stephanie, let's start with that massive gain for Laurentian Bank. Revisit the deal for us.
Yeah, absolutely. So, yeah, there was a healthy double-digit boost for Laurentian Bank that made it by far the top performer on the TSX today. It was moving by over 18% at its highest point and ended up keeping that momentum until the end of the trading day today. So it marked its biggest intraday gain in just over 2 years, and it brought the share price to levels not seen since 2023, so around that same time span. It's a story that we've all been tracking in the newsroom, including BNN, who had a few guests speaking to this. But what happened here is that Laurentian Bank announced that it would be selling a part of itself to Fairstone Bank for $40.50 a share. That marks a 20% premium to where the stock was trading before this announcement happened. On top of that, it will also sell its retail and small business assets to National Bank. So essentially breaking itself up, auctioning itself off, and Fairstone and National Bank were the buyers ultimately, or the ones who expressed interest. So all in all, this really marks the end of a really lengthy process for Laurentian Bank, which included a strategic review, a few pivots to its business strategy, etc. It was a really long saga. That strategic review ended up ending without a sale, which analysts kind of looked at as a case study of how difficult it is for small and medium-sized lenders to really effectively thrive in the Canadian lending market. But for the part of the deal here, analysts have been giving it a thumbs up, including the Scotiabank team, who view the deal as a really big positive, and in fact moved their price target from $33 to $40.50. Just matching that deal offer. They also said that they see little regulatory risk that would threaten this transaction. So after a few years of underperformance, Laurentian Bank is finally seeing some gains as it's closing the book on this business review strategy, this confusing uncertainty for where the bank will be heading. And now that it's giving shareholders some more certainty, we're seeing some strength in the share price, Marella.
Yeah, I'm sure investors are pretty happy about that. All right, also an up and down week for Shopify. It's only Tuesday, so what happened there?
Yeah, Shopify was another gainer today. Those shares jumped by 6% at its highest point. Biggest move in about 2 months, and that more than reversed the losses from yesterday. So as you said, up and down week so far. And the reason why it was down yesterday is because the analysts at Oppenheimer Research said that the Black Friday sales that we saw over the weekend were a bit moderate, a bit more subdued than they were hoping for. Fast forward to today, and in fact, Shopify merchants are reporting a record $14.6 billion in merchant sales once you factor in the Cyber Monday deal sales. So that marks a 27% boost from a year earlier. National Bank analysts were happy about it. That they said that this marks some continued strength for Shopify and really just a strong kickstart to the holiday season in general, which is obviously a good time for merchants and e-commerce firms. So the Shopify stock on a year-to-date basis has been up by over 40%, and it appears that investors are a little bit more optimistic that it can still keep that momentum going into the holiday season, especially with the strong start, Marella.
All right, we will leave it there. Bloomberg's Stephanie Hughes giving us the latest in Toronto. Coming up next, American markets in the green today, thanks to gains for Bitcoin and some technology stocks. More in a moment. Tech stocks leading gains in the market, but my next guest says the narrative around AI capital expenditure is becoming more skeptical. Let's go to Peter Berezin, Chief Global Investment Strategist, Director of Research, BCA Research. Thanks for joining us today.
It's good to be on. It's good to be on.
You say we may have reached a metaverse moment. Can you explain?
Well, if you recall what happened in 2021, Meta got punished by investors for spending too much money on the metaverse. And then, not surprisingly, they stopped spending money. So what I think will probably happen next year is that we will have a similar occasion where some big AI company announces more capital spending on AI and its stock price goes down. And once that happens, you're not going to see too many more announcements. And unfortunately, the economy has become so addicted to all this AI spending that if we go from kind of the boom in capital spending on AI to a bust, that could drag down the whole economy.
Okay, so I feel like we've already started to see that, right? Where we had NVIDIA with a beat and then stock went up for a very short period of time and then came back down. And there seems to be questions already about whether there is return on those investments. But you think this theme is going to play out even more so next year?
I think next year is when sort of the rubber hits the road. I think next year is when investors will get very much disillusioned with the whole AI narrative. Not because it's not going to lead to efficiency gains. Of course it will. AI is super useful, but that it's going to be very difficult to monetize it. And I think as investors begin to focus on that angle, you're going to see a pretty big sell-off in stocks, perhaps a big enough sell-off that this hurts the economy, pushes it into recession, very similar to what happened in 2001. That recession was more the result of a stock market crash than the cause of one.
Are the large language models, which most of us are now familiar with in some way, shape, or form, are they profitable yet for these companies, or is that part of what is holding tech back, you think?
Well, they're certainly profitable for NVIDIA, but they're not really profitable for anyone else. And that I think is a real issue. I mean, if you look at the sort of spending numbers that the hyperscalers have announced, if you take these numbers seriously, they're on track to hold something in the order of $2 trillion in AI assets by 2030. Now, the depreciation rate on those assets is fairly high. It's around 20%. So 20% of $2 trillion is $400 billion in annual depreciation expense. And for reference, the combined profits of the hyperscalers, Microsoft, Meta, Google, Amazon, and Oracle, was actually slightly less than $400 billion this year. So unless they can really grow those revenues and profits, we're talking about a lot of unprofitable investment. And eventually, investors are going to punish those companies for this sort of spending.
What do you advise investors should do for the end of the year? We've already seen some rebalancing, movement away from tech to other sort of more cyclical shares or companies that have sort of better bottom lines for a longer history. What are you advising investors to do?
Take some profits. I mean, don't go fully defensive because we're probably not an imminent risk of a recession, but take your profits, move a little bit to the sidelines, because at these valuation levels, I mean, even if you buy the whole AI narrative, at current valuations levels, historically, future returns, like over a 5-year horizon, have been very, very low. So you're not really getting paid to be in this market. There's just not a lot of upside left, but there certainly is a lot of downside if the whole AI narrative really begins to crater.
Are you on side with a rate cut in the U.S. For December? And if you are, why?
Oh, I think the Fed will cut rates. And that's partly because of political pressure, but I think it's more because the economy needs rate cuts. And we haven't had any job growth now for about 3 months. Like the latest ADP numbers point to job losses in the private sector. Wage growth has stalled out. Job openings have been trending lower. Perceptions of job availability from the Conference Board survey, from the University of Michigan survey are very, very weak. So this is an economy that's actually struggling despite the stock market boom, despite the AI boom. If you didn't have those things working for you, you'd probably be in a recession already. So I think the Fed should be cutting rates, and I think in December they will.
Peter Barrison, I've got to leave it there. So thanks for joining us. Appreciate that.
Thank you.
Propel Holdings just received approval that will help it expand into the U.S. We'll hear more from the CEO when we come back. Canadian fintech company Propel Holdings has just received regulatory approval that will help it expand into the U.S. For more, Clive Kinross joined us, Chief Executive Officer of Propel Holdings.
We provide access to credit to underserved and underbanked consumers. So for the most part, these are consumers who are overlooked by mainstream banks and credit unions. There's about 90 million consumers in Canada, the US, and the UK, which are the markets that we serve. And for the most part, these consumers could go into a bank, could open a bank account, and really get little else in terms of services. From our perspective, we are absolutely focused on these consumers. In today's K-shaped economy, we're seeing record numbers of applications from this cohort or this large segment of consumers across these geographies, and we want to put ourselves in a position to provide them best-in-class products and services, including additional products and services. In order to do that, Propel Bank represents the next step in that evolution. By having a banking license, we'll be able to do a few things for our consumers, obviously able to offer them best-in-class banking products and services over the longer term, like debit cards and credit cards and other products that we'll be able to do with the Propel Bank infrastructure. In addition to that, we're a company who've significantly grown access to credit for consumers through partnering with banks who have the same mission of being able to provide access to credit to these consumers.
Now, does this
so doing, yeah.
Does this mean then?
Let me round out the point, Roger. It's an important one, but by establishing the bank partnership, we'll be able to offer more consumers in more jurisdictions and more markets access to our and our bank partners' best-in-class products.
Will you be maintaining your relationships with the other banks, and where will this bank focus? Will it be the U.S. or larger than that?
Absolutely, we'll be maintaining our focus with our other bank partners. As recently as a month ago, we partnered with Column Bank. We're the first fintech in North America focusing on underbanked consumers to partner with a nationally chartered bank like Column Bank that extends our partnership now to 5 originating banks across the U.S., which is industry leading. By having Propel Bank in Puerto Rico will allow us to provide services to more and more bank partners. So if anything, the infrastructure provides the ability to create even more of these bank partnerships, and the real winner at the end of the day will be underserved and underbanked consumers.
And how does this tie in with anything you're doing in Canada? Will there be any crossover, or will this essentially stay separate and strictly U.S.?
It's an international bank, and certainly being an international bank will provide us with the ability to expand our services into other jurisdictions, not only the U.S., which ultimately is where our regulator is based. So we'll certainly be able to expand services into other markets down the road. I don't expect that to be anything imminent, certainly as it relates to the UK or Canada. But once we integrate with additional services, we'll be able to offer those services, including treasury services, across other markets as well. So not only does it create huge revenue-generating opportunities down the road, but certainly being a bank, there's opportunity for lots of cost savings as well, which not only is going to be good for our consumers, but ultimately good for our investor base as well.
And I just want to get your thoughts on Laurentian being sold to Fairstone. Would you call Fairstone a competitor for you? And your thoughts on that deal?
So, for the most part, the biggest markets that we operate is Canada. Is the US, followed by the UK, followed by Canada. There's been fairly significant regulatory changes in Canada over the last year or so, making it more and more challenging for underserved and underbanked consumers to get access to what I would call better products from their perspective. And a lot of them are being pushed out of, call it mainstream or near prime markets, to less desirable forms of credit. I think today's transaction, if anything, makes the competitive landscape that much smaller at a time where, if anything, consumers in Canada need access to more product into better markets. So I'm still digesting the news. The multiple, from our perspective, was certainly interesting as well, and probably points to the potential in what is currently a huge underserved market, which is the underserved consumer, where we are seeing record numbers of applications in this K-shaped economy. And I don't think that's discrete to Propel.
Okay.
I think the companies that are focused on our segment of the market are just seeing very, very strong demand at the moment.
Clive Kinross is the Chief Executive Officer of Propel Holdings. Coming up next, CrowdStrike just released earnings for its latest quarter. We'll take a look at that when we come back. Here are the stories we are following today in the newsroom. Laurentian Bank, the best performing stock in Toronto, shares surging after the lender announced it's selling some of its assets to Fairstone Bank for $1.9 billion or $40.50 a share in cash. Separately, National Bank will acquire all of Laurentian's retail and small business assets. Laurentian will focus on commercial real estate lending, and Eric Provost will remain on as CEO. Shares of Scotiabank closed higher. The lender beat profit and revenue estimates in its latest quarter, with net income surging 31%. The results driven by better than expected performance in its capital markets and wealth management divisions. Scotia also forecasts faster growth next year in its core Canadian banking division. In an upgraded outlook, the Organization for Economic Cooperation and Development says the world economy is expected to grow 3.2% this year. It had predicted 2.9% back in June. The OECD is also raising its forecast for U.S. growth this year to 2%. The organization says despite concerns about a sharper slowdown with higher trade barriers, the global economy has shown resilience. Shares of Shopify saw a spike today after merchants racked up $14 billion in Black Friday sales. That's a new record for the company. Shopify says merchants saw strong demand in apparel, home goods, and beauty products. Peak sales hitting more than $4 million a minute. Canada, the U.S., Germany, Australia among the highest selling countries. Cybersecurity technology company CrowdStrike just released third quarter earnings. Here's a look at what they had to say. Results, revenue coming in at $1.23 billion. That's a 22% year over year increase. The estimate had been for 121, so that is a beat for the company there. Subscription revenue coming in at $1.17 billion, and that's a 21% year over year increase. The estimate had been for 1.16, so a small beat for them there as well. Professional services revenue, $65.5 million, 38% year over year increase. The estimate had been for 57.3, so a very strong beat for them in that market. And adjusted earnings per share, 96 cents. The estimate had been for 94. And CrowdStrike sees fourth quarter revenue coming in at $1.29 billion to $1.3 billion. The estimate had been on the low end of that at $1.29 billion. It is also boosting its 2026 year forecast, seeing revenue at $4.8 billion to $4.81. The estimate for the Bloomberg consensus had been $4.78 billion. Let's talk about this with Todd Weller. He's Managing Director of Technology at Stephens. Thanks for joining us today.
Thanks for having me.
So a pretty strong report from this company. Is the annual recurring revenue the key metric here? It came in at $4.92 billion.
Yeah, that's the leading indicator, the top metric to focus on. It was, 0.5% ahead of consensus. Healthy growth, 22.5%. I think that 20% growth bogey is key for CrowdStrike. And keep in mind, there's been a tremendous focus on net new ARR acceleration occurring in the second half of this year, and that is materializing.
Okay, can you just tell us what products are doing well for the company?
Yeah, so CrowdStrike is unique that in cyber, right, they're a strategic cybersecurity platform. So if you look at the company's roots, they were endpoint security, but they are much broader than that today. So as we go into the call, we'll be looking at their kind of three emerging growth areas, next-gen SIM, for example, identity security, cloud security. Those are all big businesses that have been experiencing solid growth. We don't get that level of detail in the earnings release. We'll have to wait for the call, but we would expect continued momentum. But, we view CrowdStrike benefiting from kind of security consolidation, this move to strategic platforms, and it's really them today and Palo Alto Networks that are the two strategic cyber platform providers.
Who would be its biggest clients?
CrowdStrike has lots of customers. They're large enterprise down to mid-market, but they are widely used. They're the number one market share player, in terms of pure play next generation endpoint. So broad-based across industries, like I said, large enterprise down to mid-market. CrowdStrike's really a household name, household brand company in cyber.
The AI rollout, would that be positive for them internally, and would it affect their customer base in a way that they would require more cybersecurity?
Yeah, so unlike other areas of software in cyber, AI has been generally viewed as positive, right? It's creating more sophisticated attacks, easier, but it's also expanding the attack surface as organizations deploy AI infrastructure, right? Whether that's their own models, AI agents, that's a new attack surface that has to be secured. And some of that's occurring in cloud environments, so it's fueling kind of cloud security growth. Some of it is occurring in on-prem environments, but it's early stages. CrowdStrike did a recent acquisition of a company called Pangea here, and there's a lot of cyber companies going after that market. But we think AI is a big opportunity for cyber in general.
Okay, let's talk about competition. You mentioned Palo Alto. I'm wondering if some of the other big tech names are also getting into cybersecurity and posing any threat to CrowdStrike.
Yeah, look, cyber is competitive. The big are getting bigger. So I do think companies like CrowdStrike and Palo Alto, by being focused on cyber and being big, have scale advantages. Microsoft has long been a player in cyber. They've long been, also a player in endpoint security with Microsoft Defender. But that's left plenty of growth and opportunity for CrowdStrike and others. Clearly, Google, right, with the acquisitions they've done of Mandiant, and then most recently Wiz Security is eyeing the space. And then you've had companies like ServiceNow make a move. So I think cyber is increasingly being viewed as an attractive space. It's always been competitive. There's always been competition from bigger companies, but I think CrowdStrike, Palo Alto, and other focused cyber players have proven, there's plenty of growth opportunity for companies focused on the space.
I was going to ask you, because we know that some of the tech stocks have been taking a bit of a drag down towards the end of the year as people worry about spending. I would imagine the cybersecurity companies are not in that same vein.
Well, the stocks had a tough November, so I think it was nothing fundamental about the group. I just think a lot of tech and a lot of software underperformed due to concerns over AI and valuation and the sector rotation. It's interesting. Sometimes you do see inter-sector rotations where people might flow into cyber because it's safer, but I don't think you really saw that in November. But generally, we think fundamentals for cyber continue to be healthy. We saw some good September quarter results, and the October quarter results we've seen to date have also been healthy.
What does the company have moving forward, looking into 2026, that it has a lot of growth potential for it?
Yeah, so as we get into next year for CrowdStrike, again, it's going to be these newer areas. We think, next-gen SIM, which is, security operations center platforms, that's an established market that is going through like a renaissance, a modernization. So we think that's going to continue to pick up momentum. I think identity security remains one of the most attractive areas in cyber. CrowdStrike's increasing their focus there, and we expect strong growth there. Cloud's going to continue. Again, a lot of AI is happening out in cloud environments. And they also have other emerging areas like exposure management. So CrowdStrike is exposed to a lot of big cyber markets that have attractive growth opportunities. And I think it's continued execution there. And then I think as we look to next year, we look for AI to start to become more material in terms of demand for AI security solutions. That is also driving data security too, where CrowdStrike has exposure to.
Is it going to be more efficient if it uses AI within its own operation?
When you say more efficient, like CrowdStrike using or cyber companies?
No, CrowdStrike using AI within its operation to become more efficient, like we're seeing other tech companies or financial companies right now do.
Yeah, look, at the margin, CrowdStrike's talked about increasing internal use of AI, whether that's around like customer support, right, software development type stuff. And I think at the margin, that will be a net positive for profitability. And we expect continued improvement for CrowdStrike profitability as we get into next year. But I think the primary focus here will be on growth. And one thing I would say, in their release, they did reaffirm the guidance for next year's net new ARR growth of 20% growth. That was an initial outlook they gave at their analyst meeting a few months back. That was better than street consensus.
Got it. All right, Todd Weller, sir, thanks for joining us. Appreciate your time.
Thank you.
Well, we'll hear about the record year for ETFs and the shift from the TSX 60 to the broader TSX Composite. That's coming up next. For more of the latest ETF fund flows and where investors' money seems to be going, we were joined by Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets.
Record year 2025. We hit the kind of inflow record even ahead of the U.S., but both markets are on pace for 20% growth in additional capital flowing into the ETF structure.
And even in November, which saw some choppy trading weakness in the tech stocks, for example, there were still people buying equity ETFs.
Yes, another month, another record. This year in the U.S., it was the highest daily average inflows into ETFs all year, $7.3 billion a day going into ETFs. And this is over double the 2024 run rate. So just incredible growth. And yes, November was a choppy month, but ETF investors were there and deploying capital.
And despite these worries we hear expressed about a handful of tech stocks dominating the S&P 500, that giant Vanguard S&P ETF just bringing in money.
It is like a vacuum cleaner, just kind of cleaning up assets. And really, this is just showing, I think, the retail interest. And you know what? These investors were almost treating any day of market weakness like a Black Friday sale and seeing this as an opportunity to put additional funds to work. So we're seeing cash, I think, coming from the sidelines and moving into S&P 500 exposure, especially if there is any daily weakness or sustained weakness.
So we got this giant VOO, the Vanguard S&P 500 ETF, and you say it's taken in about $125 billion US year to date.
Absolutely stunning. No other ETF in the world has taken in so much capital, and it's nearly 10% of all US ETF flows. So one in every $10 invested in an ETF this year has gone into VOO. It's just incredible.
VOO, is that what you call it?
That's what we call the ticker.
Okay, thanks. Yes. We always love to get a bit of jargon here.
Yes.
The leveraged ETFs have been another hot commodity this year. They come in different forms. Sometimes it's leverage, or sometimes they use engineering to increase the yield.
Correct. So there's this what we call like a light leverage, which is a little bit of a quarter turn just to enhance returns. But then there are these kind of major leverage products. So it's 2x, 3x. You're really trying to amplify the return, amplify kind of the investment you're making. And we saw incredible inflows into leveraged ETFs in November, $6 billion, the second highest monthly inflows into levered ETFs. And really, again, this is investors trying to bottom pick the market, seeing different pockets of weakness and think they can take on the additional risk because it's going to turn into additional returns.
And can you just remind us, I know we can't get into the weeds too much here, but these leveraged single stock ETFs, are they designed to be held over an extended period, or are they one of these deals where you just capture the daily move in the stock?
Yes, absolutely not. Do not hold these products over an extended period of time. There is this mechanism called NAV erosion, which it happens in all this kind of structuring. They are primarily meant as kind of daily or weekly trading vehicles. You have a directional bet, you make that bet, but these should not be buy and hold products.
I wonder, are a lot of investors buying these things thinking, well, it's leverage NVIDIA, I'll just hold it, and that's often a bad idea.
That is a bad idea. The way these are designed are meant to be trading vehicles and kind of short-term in nature.
We have seen outflows from Bitcoin ETFs with the decline in crypto prices, but you're saying it hasn't been a wholesale flight?
No, actually, and I think it's really proven kind of the investors that are using the ETF vehicle to allocate to cryptocurrency. So it's been a very violent move in the price. I think 30% from October highs lower. So 30% is a massive move.
Yeah.
But we have not seen outflows. We have not seen investors running to the exits. There have been kind of modest outflows, I think $3 billion, but that is less than 5% of all AUM. And I think it's just proof of concept that investors are using the ETF to make a portfolio allocation, using it as a real allocation tool rather than a trading vehicle.
Now, we don't have the same prominent tech stocks, obviously, dominating our index in the same way as the US, but people have a choice here. They can buy the traditional XIU, which tracks the TSX 60, which generally follows the composite pretty closely. But are you seeing more interest in investors wanting the other stocks?
Yes, we've seen the composite, which is a broader index, 250 Canadian equities versus just the largest 60. And we've seen consistent outperformance. And this outperformance has been the trend over the last few months, but we saw it even further exacerbated in November as well. This has really been driven by the materials sector. There's a larger weighting in the composite, and that has been a key driving force of this outperformance. And so to the tune of 30 basis points in November, you had outperformance in the composite versus the large caps, Canadian large caps.
And I think this is for November. There were nearly $4 billion of inflows into Canadian equity ETFs.
Absolutely incredible. And the $4 billion is 4x the kind of monthly run rate. And so this has really been driven by institutional demand. So really the institutions kind of backing this narrative and putting my assets to work through the ETF and buying Canadian equity exposure right now. So it's really been a proof of concept and really seeing those big flows follow the performance.
Valerie Grimba, Director of Global ETF Strategy, RBC Capital Markets. Coming up, we'll hear from the CEO of Lyft on the company's new donation initiative. That's next. Rideshare company Lyft is giving back this holiday season. David Risher, CEO of Lyft, joined us to discuss his new donation initiative, growth outlook for the company, and what he says makes his company different from competitors.
I think more of all the people who are driving their own car or even maybe sitting at home, not even getting out, and really wanting them to get out and experience, the best of life. I mean, our whole focus on Lyft is customer obsession is what drives our profitable growth. And we've been super obsessed with customers. We've got great drivers on the platform. We've got great riders on the platform all across Canada. We've actually doubled our presence in Canada over the last year. So a lot of wind at our back, just sort of making things good for us.
And how are you drawing them in? What are you doing that you doubled your numbers in the last while?
Yeah, some of it's through partnerships. For example, we have a big new partnership with United Airlines, which is a wonderful partnership. It allows you to get miles on United every time you take a lift. We've got a partnership with DoorDash in the United States. Hopefully we'll get that in Canada fairly soon as well. So that's a big part of it. And then a huge piece of it is just doing the basics right. Like, check both apps. And I always encourage people, check both apps, see who's got the best pricing, see who's got the fastest pickup time. And we think more often than not, that's going to be us.
And so with that, what about talk about autonomous? We're seeing that more and more now. Yeah. Where does Lyft fit in? Where do you see yourself fitting in with that? We could see it coming sooner than rather later. Sometimes it feels like.
You know what? It's so interesting. So autonomous cars, self-driving cars, for years and years, they were sort of a science fiction pipe dream. But really, over the last couple of years, they've really come into focus. And certainly if you visited San Francisco, for example, where I live, you'll see them all over the place. They're almost hard not to see at this point. So what does that mean for riders? What it means is you're going to have new choices on platforms like Lyft. We've got a great partnership with Waymo, who's really the market leader in the United States. We have a great partnership with Baidu, who's one of China's leading AV tech providers. That's going to be our main partner in Europe. And what you'll be able to do on the Lyft platform is be able to open up and choose to get an autonomous car, a self-driving car. Now, why might you like that? You might like it because they tend to be very reliable. They're quite safe. Frankly, robots are safer than humans when it comes to driving. And so they add a new, kind of dimension in the marketplace. But the other thing I would say is that's still kind of science fiction in the future for most people. We're going to be building what we call a hybrid network, which will have some self-driving cars, but still the majority, driver-driven cars for many, many years to come.
And with your drivers, how are you keeping them? How do you do retention? If they're looking at that going, you know what, we may be replaced by, well, actually just an empty spot in the seat. How do you retain them? What are you doing to try and keep your drivers happy?
Sure. I think it's a very real issue for us to be concerned about it. But I also think this will take many, many, many years before anything like even 10% of our business being, driven autonomously would be a huge, huge success. And that's over the next 5 years. But the thing that we're doing for drivers, we do a couple of things. We guarantee their pay in all kinds of ways, particularly around what we call a minimum earnings guarantee, where they'll always earn 70% or more of what a rider pays after fees. That's really important for a lot of drivers. And we've got a great driver loyalty program that helps drivers with things like, discounts on gasoline, and other things like that. And that's been an incredibly successful program as well. We now have a 27-point advantage among drivers that drive for both us and the other guys in terms of preference. So that's wonderful. It really shows that what we're doing is resonating with drivers.
And okay, let's turn over to Roundup. Let's talk a little Christmas spirit and donating. Tell us a little bit more about that, the program.
It's such a great program. You've probably experienced this yourself, maybe on Lyft or maybe in a supermarket where you go and you'll be asked to round up your change. If it's $7.20, round up that 80 cents and give it to a nonprofit. We've got a great list of nonprofits that you can donate to. The Canadian Red Cross is one. True Patriot Love Foundation is another. Food Banks of Canada is another. In Montreal, we're working with Rue des Femmes and Maison du Père and a couple of other local nonprofits. In all, since the program was started in 2017, Lyft riders have donated over $42 million US dollars to charity. And this Roundup and Donut today, because of Giving Tuesday, I'm personally matching every gift as well as Lyft. So donations get double matched today.
And incredible, thank you for doing that. And the charities, I imagine, are very happy for you doing that. Can people choose? You mentioned all those different charities. Do you get to choose, or does it kind of go into a pot and then and then you'll decide where the money's going?
No, you get to choose. You get to choose. If you go to your profile and literally, go to the word donate, you'll see a whole list of charities you can give to. And remember, once you lock it in, you can keep it on for as long or as little as you want to, and you can always change nonprofits to focus your funding towards.
And what kind of a response have you been getting from people through over the last 2017? You said it started, right?
Yeah, as I say, it's been about $42 million that people have given. We're talking about hundreds of thousands of people who use the program every single year. But frankly, hundreds of thousands of people, given that we have over 50 million riders, is just too small. So, I want to double it and double it again. That's why, again, I'm doing this personal match today to try to encourage as many people as possible to give. And remember, you're talking about small amounts of money individually, 20, 30, 40 cents a ride, but it adds up. As I say, $42 million is not nothing over 7 years.
Time now for Hot Picks. We focused on three plays in the auto sector. We were joined by Tom Narayan, lead global autos equity analyst at RBC Capital Markets. And we started with this top pick, Ferrari.
They have an interesting opportunity, investors do, because the stock has pulled back 20% after its October Investor Day. And there's some people worried about its EV. We are not. They have this really interesting car, the F80. There are 800 of them they're going to sell. They're $4 million cars. When you do the math on that, it's incredible, super profitable. So the setup is really great, given this 20% pullback in the stock. Finally, investors who want to buy this stock, I think it's a great time for them to participate. And they get to benefit from this F80 car, which starts deliveries in Q4 of this year.
What's that car? Sorry, Tom.
Yeah, it's basically...
Go ahead.
It's basically a supercar that's they're going to make 800 of those in its lifetime. They're going to sell them over just 3-year period, and they cost $4 million a car. So the profits on those are incredible, right? Unless you're putting $1 million of costs or something, which is, a car is a car at the end of the day. So super profitable, huge boost to numbers in 2025 and in 2026, and then really 2027. I think some folks who got a little spooked at the October 9th Investor Day. I think there's a lot of new people in the stock who kind of pulled out. And now I think the core holders, the people who want to own Ferrari, are kind of waiting on the sidelines a little bit. But now I do think folks will start buying the stock.
Let's get a little more mundane here. General Motors, you see upside here, Tom. Why is that?
Yeah, I mean, this one has been a great performer. It's hard to also pitch this one now, given how strong it's performed, but I still think there's more upside here. Tariffs has been a great story, the resolution of them. They really benefit GM. USMCA is going to be negotiated, I think, June or July in 2026. It's a big catalyst for them. Also, they do have some tariffs that come from their Korean imports. So we'll see probably some resolution there. And then outside of that, this is just as steady as she goes, 65, 70% of the large SUV market, and probably the best auto market in the world, the United States. They don't have to worry about China coming in the U.S. because of tariffs and because Americans aren't really buying EVs. It's a great relative play, and it has been working. So, yeah, if it ain't broke, let's keep going.
And what about pushback in America to the high sticker prices on cars? Presumably that'll curb sales growth. People are just tired of these massive prices.
Yeah, no, you're right. But that's been the case for a while now. Yeah. Since the pandemic, we've seen a huge bout of inflation in car prices. But at the same time, unemployment is really low. The economy is actually pretty healthy in the States, except for maybe the kind of lower end. People if you need a car, you have to buy a car. That's it. How do you else get to work? It's not a discretionary purchase, really. And, we calculate like a 6 to 7 million vehicle deficit, cars that were never purchased since the pandemic. Partly it's because of the high prices, but also it's just, people weren't buying cars and they still need it. The cars are getting old and they have to replace the car to get to work. So, so we still think there's going to be some support, even despite the high pricing.
Tom, finally, Aptiv. Remind us what they do and why do you see upside? Sure.
Yeah, this is a really interesting auto supplier. They do some of the assisted driving technology, cameras and some of the software there. And then they also do some hardware stuff, right? So they do wire harnesses and some of the electrical components. Why we like this stock, partly it's what we just talked about. There's a lot of strong demand in autos in the U.S., particularly their kind of core market. But also there's something cool that's happening. They're spinning out that wire harness business, and we think potentially it could get acquired. So, if you're buying this stock now, you get to benefit from a takeout price of that asset or even the spin out. And then, it's kind of the sum of the parts. You get to value all these different piece parts and also benefit from tariff recovery, relief next year, as well as the secular driver, which is this assisted driving ADAS functionalities.
Yeah, it's fascinating. Assisted driving and automatic driving, Tom, are we going to see incredible progress in the next few years, do you think?
Yeah, I mean, people have been waiting on this forever, including myself. It's been kind of slow going, right? Like people either want the car to drive them completely or not at all, right? So it has been difficult to kind of get consumers on board, but we are seeing this in China. I was just actually there last week, and people love that product, assisted driving. And of course, these guys, Aptiv sells these products in Europe, China, and the U.S. And we do think ultimately American buyers will want these products. And, eventually we'll get to a point, maybe it's level 3, where your eyes are off the road and your hands are kind of not on the steering wheel, but you're sitting in the driver's seat. That could be the kind of evolutionary phase that we go to next. And then a company like Aptiv is definitely a beneficiary there.
All right, let's have a last look at where we landed today. A bit of a mixed ending for the North American markets, with the TSX the only one in the red with a 52-point drop. Thanks very much for joining us today on The Close. We'll see you back here again tomorrow.